We briefly looked at the banking imperatives under climate change, and it's not like they are to be something to be worried about in the future. The future is already here, so the banks are already being asked to put themselves through these risk analysis in terms of physical risks that are acute or chronic, and the transition risks needed to move the system, entire human system, natural system, into a new phase of renewable energy, and worrying about coastal sea level rise, cyclones, hurricanes, crop productions, etc. And transition risks, etc., are affecting bankings in terms of the risk they have to report for the investments they're making, the default rates they expect, and so on. These two reports I'm combining here are brief reports from the Morgan Stanley Climate International, and they are looking, in the first one I will just show a figure at the property risk in major metros, but the main tagline there is that the risks vary within a market and across markets. So we're looking at average physical risk versus risk distribution across major metros, and various climate factors play into it depending on which metro you're talking about, as we'll see in a minute. So MSCI Real Assets Climate Analysis is used to present this figure. The physical risk impact of an asset is quantified by assessing the exposure of a property to a hazard and computing the costs associated with that risk using vulnerability functions specific to the real estate market. In the IPCC lingo, we call risk as a multiplier of vulnerability, hazard, exposure. From AR5 to AR6, now the response also has been added as a multiplicator going into computing risk. So various factors that are used to compute vulnerability are very important to understand as well, which we will not get into. So this is looking at climate VAR physical risks, individual assets, and metro average. So climate VAR is basically physical risk, climate value at risk in terms of percentages. Okay, climate value at risk. Physical risk, climate value at risk. Climate value at risk, physical risk band, percentage of properties here with the color codes coming from negligible and risk reduction, so greater than minus 0.5. So it's the value depreciation in that sense. Moderate risk minus 0.5 to minus 5%. Significant risk from minus 5 to minus 25%. And severe risks are less than minus 25%. So it's a negative scale. And average physical risk for metro are shown here in those color codes from severe risk to moderate or significant risk. So this is for Amsterdam Randstad. The color code is all blue, which comes from coastal flooding, and you have other categories of predominant hazards like other and tropical cyclone. So if you go to Shanghai, you got a little bit from tropical cyclones, for example, and the risk level is severe at, fairly significant percentage here, close to 50%. So you're going from minus 100% to 0% here. So when you come to 0%, obviously you have negligible and risk reduction even, right? So Miami and South Florida, you have risks from hurricanes, obviously, and some from coastal sea level. Hong Kong is mostly all coastal sea level with typhoons coming in as well. Houston, mostly all from sea level and cyclones. Similarly, Tokyo, all sea levels and cyclones. I won't read all of them. DC Metro here, mostly from sea level rise and cyclones and other. And let's see, Chicago, mostly from other. So it's winter storms, heat waves, and various other factors that play into vulnerability and risk for climate value at risk. Okay, so this gives you a sense that people have to worry about these physically induced risks to property in metro areas. Of course, it works for other areas as well, but this particular report just looked at the metro areas for property risks. Now, for the idea of looking at underwriting biodiversity. So biodiversity has some value. There's always been an issue about how to define the value, ecosystem services, and so on. And of course, it's very complicated because if a tree is standing there, it has no real value that you can quantify, although you can say it provides shade, medicines, fiber, food, etc. But if you cut it and make furniture, it's easier to put a value on it. So putting value on forests, biodiversity is always very complicated. Nonetheless, we have to now start thinking about underwriting them in terms of protecting them from climate change or in a warming world. So a few points are made by another report from MSCI. Few points. There is a link between biodiversity loss and higher underwriting risks. This relationship is especially clear for insurance covering floods, crops, life, health, and environmental liabilities. So human systems are now being included: crops, life, health, and environmental liabilities. Some property and casualty insurers already use geospatial analysis in their pricing, claims processing, and risk management. Adding a layer of biodiversity data to this analysis may help incorporate biodiversity considerations into underwriting. We found that 37% of the constituents of the MSCI ACWI work had 3 or more known physical assets in biodiversity sensitive areas. Of these, 13% lacked adequate policies and programs to address impacts and related risks related to biodiversity loss and land use. Okay, I have somebody knocking at the door, so let me stop for a second and restart. Okay, sorry about that. It's always a pain when somebody interrupts. So where was I? There was a delivery I had to take. So we were talking about 37% of the constituents of the MSCI ACWI index had 3 or more known physical assets in biodiversity sensitive areas. This is the capitalization weighted index, which is some index that MSCI tracks, and they provide all kinds of advices based on these sorts of indices. It includes multiple countries and so on. So exactly speaking, that's adjusted market capitalization weighted index. Companies that operate in biodiversity sensitive areas don't always have strong environmental management practices. So we have talked about environmental, societal, and governance kind of reporting compliance issue now everybody has to face. So we are looking at this here, for example. So we are looking at flagged and not flagged companies that operate in biodiversity sensitive areas. So data is from as of January 31, 2023. Weak risk management practices are defined by risk management scores below 3 out of 10. So this is again from the MSCI ESG research, environmental, social, and governance issues. So operations in biodiversity sensitive areas, they have flagged 37% of the companies, 63 are not flagged. ESG ratings are the key issues here. So ESG practices, performance metrics, and controversies are the outcome of not meeting the standards of ESG. So engage with high-risk companies, support regulatory and voluntary reporting, underwriting, and investment exclusions. These are the issues they have to worry about in terms of weak risk management. So 37% of the constituents within the MSCI ACWI index had at least 3 known physical assets in biodiversity sensitive areas, of which we found relatively weak risk management practices in relevant key issues, which included biodiversity and land use at 13%, toxic emissions and waste at 20%, and water stress at 39%. One has to also worry about how these will get worse over time with warming. Within the constituents assessed on biodiversity and land use, 12% or 32 of the companies here faced severe or very severe controversies. Okay, and the controversies include things like engaging with high risk companies, supporting regulatory and voluntary reporting, underwriting, and investment exclusions. Examples of how biodiversity risks may impact underwriting activities, looking at biodiversity impact and potential underwriting risk, again from data of March 2023. Flood insurance is one. Deforestation leads to increased flooding, so that's the link why companies have to worry about it. Crop insurance, pollinator extinction is happening, water scarcity is an issue, soil erosion threaten food production together with pollinator extinction and water scarcity. Liability insurance, significant biodiversity damage due to company actions. Life and health insurance, human health is influenced by surrounding ecosystems, so there's a direct link to biodiversity, and air quality and water quality also depend on biodiversity, so airborne, waterborne diseases are also affected by those. Also, there are zoonotic diseases. If you cut down forests and you have deer coming into your backyard, you could have Lyme disease, for example. Potential underwriting risk, physical damages of insured assets under flood. Lower crop yield causes higher insurance risks under crop insurance, and insurers become liable for biodiversity damage under liability insurance, and higher mortality and morbidity ratios affect life and health insurance. So you can see how cleanly they are mapping onto each other. Flood insurance, so in terms of tools, in 2021 floods caused an estimated $82 billion of economic losses globally, with only about a quarter of these losses covered by insurance. A global study found that with every 10% increase in deforestation, flood risks increase between 4% and 28%. That's quantification of biodiversity loss, deforestation to flood risks. Crop insurance, pollinator extinction, water scarcity, and soil erosion threaten food production and expose insurers that underwrite the agricultural industry to higher claims due to potential crop losses. Liability insurance, insurers that underwrite environmental liability insurance may be directly liable to pay for the necessary cleanup and restoration of biodiversity. This happened in a different context with BP, which had this Deep Horizon and massive oil spill in the Gulf of Mexico. They had to dish out many $billions to clean up the system and also allow for research to address such catastrophes and the outcomes. Mispricing of this risk could impact insurers' profitability. Life and health insurance. Nature is a key source for developing medicines. However, with ongoing biodiversity decline, humankind may lose at least one important medicine every 2 years. One important medicine every 2 years. That's quantification. Reduced nature-based medicine sources could substantially increase healthcare costs, which may in turn impact the life and health insurers. Okay, so this is a very brief introduction to nicely add to the banking imperatives that we talked about that banks will face, and we have also talked about the scenarios, climate scenarios, transition to financial system risks, and how the central banks have to run the risk analysis as well. So this is all coming together in terms of driving the financial system and remembering the network for greening the financial system and its approaches to bringing climate risks into the financial system. There are other aspects under UNFCCC and World Bank about green funding, funding green projects, and so on. Then there is a separate issue of loss and damage, which we have discussed separately as well. So all these relate to climate risk and how they cascade into the financial system. Okay.